Dirty dealings, corporate battles, consumer woes. This is Evening 5. KNM Group subsidiary KNM Europa has signed a conditional sale and purchase agreement that will see it exit loss-making FBM Hudson Italiana. At a signing ceremony today, KNME agreed to sell FBM Hudson for €16.5 million to BM Carpentry Oil and Gas and Officine Piccoli. BMC will acquire a 60% interest in FBM Hudson, while Officine will take the remaining 40%. Once completed, KNM is expected to book a loss of $94.34 million and is expected to be completed in June 2024. As a result of this disposal, KNM said the purchasers assume all debts and liabilities of FBM Hudson and ensure a positive equity and cash position for these two entities to thrive and grow into the future. KNM Chairman Datuk Yaacob Khairah said this strategic decision reflects the group's commitment to optimizing its portfolio and focusing on core profitable businesses as part of its ongoing efforts to strengthen the group and drive sustainable growth for KNM going forward. It should be pointed out that the disposal is subject to condition precedents, most notably the Golden Power approval by the Italian government. Established in 1941, FBM Hudson is principally engaged in the design and manufacture of heat exchangers and high-pressure equipment for oil and gas, chemical, petrochemical, oil refining, power and fertilizer. Gamuda's net profit rose 7.3% year-on-year to $208.8 million in the second quarter on the back of higher revenue from its overseas project. Revenue more than doubled to 3.33 billion ringgit. The group said its quarterly revenue from overseas projects surged to 77% of overall revenue, while quarterly net profit surged to 58% of overall earnings. However, Gamuda's net profit for the first half plunged 70% year-on-year to 403.8 million, even as revenue rose twofold to 6.14 billion, mainly driven by stronger overseas performances of its construction and property divisions. On its prospects, Gamuda said that its performance this year will be driven by its overseas construction activities as projects in Australia and Taiwan continue to accelerate. The group said that its resilience is underpinned by a large construction order book of 24 billion and unbilled property sales of 6.7 billion ringgit. Gamuda also pointed out its healthy balance sheet with a comfortable net gearing of 29%, which is still well below its self-imposed gearing limit of 70%. The Public Accounts Committee is set to launch an investigation into the National Integrated Immigration System project, its chairperson said. The committee was surprised by the High Court's decision, which ordered the government to pay a sum of 231.5 million to Awan Biru Technology, formerly Prestariang, for the termination of the National Immigration Control System project, Datuk Mas Emriyati Samsudin said at a news conference. The committee plans to summon witnesses from the Home Ministry, Immigration Department, Malaysian Administrative Modernisation and Management Planning Unit, as well as cybersecurity experts and vendors involved in NIISe and SKIN, she said. The proceedings are expected to take place after the Hari Raya celebration and will be conducted under Dewan Rakyat Standing Order 771D. Both the SKIN and NIISe projects aim to replace the Malaysian immigration system, which has been in place for over 20 years. The SKIN project, valued at 3.5 billion, was awarded to Prestariang SKIN back in August 2017 by the previous Barisan Nasional government that was helmed by now jailed former PM Datuk Sri Najib Razak. However, in December 2018, the Pakatan Harapan government decided to terminate the project in favour of a new system to save government funds. In April 2019, Awantech took legal action against Putrajaya, seeking 733 million for the termination of the SKIN project, and after both parties failed to reach an agreement following talks, PSKIN then pursued legal recourse. After a 5-year legal battle, the High Court ruled in favour of Awantech on March 14th this year. Meanwhile, the NIISe project, valued at 1.16 billion, was initially awarded to Iris Corp in January 2021, but was later scrapped by the current administration. Iris announced its intention to take its dispute to the Home Ministry over the cancellation to arbitration. The Home Ministry is currently undertaking the bidding process for the NIISe 2.0 project, with 3 companies reportedly shortlisted by the government, namely Dagang Exchange, High-Tech Padu and Data Edge. Calcium carbonate producer Zantat Holdings made a robust debut on the ACE market, opening at 40 cent, 60% higher than its offer price of 25 cent per share. While it did not manage to hold on to its gains, it still closed 12.5 cent up to end the day at 37.5 cent. It was the most actively traded stock on the bourse today, with over 92.9 million shares traded. Looking ahead, Managing Director Ivan Chan said the group expects the glove industry to recover from the previous downturn in the second half of 2024, which could generate extra revenue for the company, as its products are used as fillers for the glove industry. He further expected that demand from India to remain strong, adding that the country accounted for 60% of its total revenue. Chan added that for its new bioplastic products, the group is planning to expand its footprint to Australia, New Zealand and Europe. He says Zantat is collaborating with strategic partners to produce compostable garbage bags, which will be exported to these countries in the near future. The group saw Zantat Perak Plant 1, whose products are primarily exported to the plastic industry in India, achieve an average utilization rate of 94% for the 9 months of FY 2023. However, Zantat Perak Plant 2, which is used to produce bioplastic compounds, recorded a utilization rate of 28%. However, Chan acknowledged that the company faces challenges in recruiting talents for its R&D facilities, primarily due to the specialized nature of the industry. The collapse of the Francis Scott Key Bridge and the suspension of operations at the Baltimore Port's private and public terminals after a 948-foot container ship collided into the bridge are set to affect courier services, said GDEX MD and Group CEO Tiong Teck Lin. In a text reply to The Edge in the aftermath of the incident, Tiong said the most affected problems regarding logistics with the collapsed bridge will be container ships heading to Baltimore Port. He said they will either be waiting for the port to be operational again or for those containers to be diverted to other ports in the US. However, Tiong opined that the Baltimore problem would not be as serious as the Red Sea crisis, as there are ways to speed up ship access to Baltimore Port rather quickly compared to the Red Sea issue, which is more geopolitical in nature. He said that the problem with both the Red Sea and Baltimore is added cost and delay in logistics costs for shipping containers via the route. As such, Tiong said the couriers have to plan how to manage costs more efficiently. He says that one of the ways to contain costs is to improve efficiency even more by deploying more artificial intelligence to speed up the process and at the same time reduce labor.